Hello, everybody. Hello. Thank you for joining us today on today's talk. And I'm happy to have Mr. Omar Azhar with us from the ZKsync team. And today we're going to talk about stablecoins and tokenized deposits for institutions on chain. So exciting topic. And maybe the first thing would be to let Mr. Omar intro himself and talk us a little bit about ZKsync, the team and the vision and the dream.
Yes, thank you for having me. Happy to be here. Yeah, as you said, my name Omar Azhar, head of business development at Matter Labs, which is a core company behind ZKsync. And what we are effectively building is a neutral network for regulated financial institutions where you do not have to necessarily trust the operator or the protocol itself. And we do this with our main product called Providiums, which are a fully private permissioned layer 2 for banks and institutions, where all the data effectively sits within their own four walls, and everything is verifiable and enforced through ZK proofs.
Amazing. That's very interesting, and I want to dive deeper into it. Sort of following today's program, I want to start from scratch, talking about tokenized deposits first. Really curious to understand your perspective about why do you think they differ fundamentally from stablecoins. So maybe we can start there for like a lot of viewers that don't have this context.
Yeah, so everyone is very familiar with stablecoins right now, right? Stablecoins are fully open, permissionless. You've got USDT, you've got USDT, you've got PyUSD, a lot of these, and then now you're starting to see stablecoins that are also non-USD. So, for example, you've got a number of Euro stablecoins coming out, and other countries are also coming out with different their own version of stablecoins. And so everyone has seen stablecoins in the open, public, permissionless blockchain world. They have definitely found really good product market fit, well over $300 billion in total stablecoin assets in general. We've seen a lot of companies start using them, especially with retail, for payments, cross-border remittances. And then it also seems like they've captured quite a lot of demand from the side of the world where there are people that want to have access to US dollars. However, stablecoins, they're kind of like a bearer asset, right? And their permissionless nature, fully open and public, is not necessarily it's kind of the other side of what bank deposits are, right? Bank deposits sit on a bank's ledger. They're fully private. You should not be able some outsiders should not be able to see, the transactions that are happening inside a bank or between banks as well. And so tokenized deposits are kind of the other side of the coin compared to stablecoins, where they are pretty much considered one-to-one with bank deposits. So they have the nice properties that banks like, which is one, they can keep them on their balance sheet, which means they can keep using fractional reserve banking, lend them out, grow their asset sheet, and get yield on them. So from a banking perspective, they're much more similar to how their existing balance sheet works and how their current operations and business works. Whereas stablecoins, they don't have the same type of treatment on a bank's balance sheet in most cases. And stablecoins, they have a great use case from a retail and user perspective when you want open permissionless money, but they don't have the same properties as if you have a banking relationship and you are using your bank account and your bank deposits to do types of transactions. This is particularly noticeable, I would say, in more the wholesale or commercial and large B2B banking environment, where I don't think we have seen too much of a pickup in stablecoins being used for those types of payments just yet. Mostly because if you're much larger on the commercial side, enterprises, you do still want to maintain those banking relationships. And because there are plenty of additional services, for example, like FX, where much of the liquidity is still in the banking side as well.
Okay, I see. So effectively, I would say tokenized deposits are a way to scale the value transmission on chain on chain rails, utilizing like the banking reserves, as instead of like the private entities that are back in stable coins that are being transmitted today on chain. This is like this is very interesting. You mentioned privacy as well, is one of the maybe fundamental like sort of dividers between the two. When you interact with institutional operators, and when they look at stable coins today, what would you see as like structurally unresolved? Privacy is one of these things, or maybe other things such as compliance, balance sheet treatment, or maybe even interoperability. What would you say?
Yeah, I think all of those have some mix of importance in these discussions. I would say that it goes back to the balance sheet treatment and the business side of things and the counterparty and operational risk between tokenized deposits and stablecoins, which is a big factor. And obviously, yes, privacy is one, but I think privacy is starting to become, you're going to start seeing many more options, even on the stablecoin side for privacy as well. So it really comes down to an individual institution, where do they see the benefits of stablecoins and when do they want to use them versus when do they want to see tokenized deposits? And I think one of the interesting new models that we're seeing many banks start to come to is, when it's within the bank's perimeter, so let's say within their own Providium or their own network, they should be able to keep them as tokenized deposits. And if it needs to leave for, like, say, an outgoing payment, etc., it could be converted to a stablecoin. Now, obviously, that there are some infrastructure, interoperability, and settlement questions that have to be sorted because to convert a tokenized deposit to a stablecoin from another issuer, you kind of have to do that interoperability action, which could create some potential fees. But I would say, banks are trying to coalesce around the model that potentially, when it's inside the network and their own perimeter, it's going to be tokenized deposits, and when it has to leave, it would probably become a stable coin because stable coins being with their permissionless nature. Now, that is what is happening right now, I think, mostly because there isn't necessarily a good way to clear or settle tokenized deposits between banks just yet. But that is something that we're starting to see pick up as well with example, like for example, Cari Network, which is effectively, trying to solve that problem statement of how do you have B2B payments between banks. And we're starting to see that as well with the various different clearinghouses across the world also trying to solve that problem statement too.
Okay, I see. I see. So you would say possibly like tokenized deposits can also like be swapped into stable coins, transacted cross-chain. Personally, I wondered like if the privacy sort of feature would be preserved once there's like cross-chain interoperability enabled. Maybe that depends whether like the sort of the cross-chain transaction of the tokenized deposits happens like within elastic chains on ZKsync, or if the deposits get swapped for stable coins somewhere else. Um,
Yeah, so I think there's two layers to that problem. So one is the actual underlying protocol technology and the underlying infrastructure or network technology that can enable for fully private interoperability between networks, but also doing that atomically as well. And then the other side is the actual cash and settlement side is, can you send a tokenized deposit to another institution, or does it need to go through a clearing facility, or do you have to swap it out for a stable coin?
I
On
see.
the first layer, the actual infrastructure side, this is something that we're solving at ZKsync. We've kind of already solved this with Providiums. We have fully private atomic interoperability between Providiums. So you can send from, let's say, Bank A running their own Providium to Bank B running their own Providium. You can send any asset, you can make smart contract calls. All of that would be private and atomic as well. Then the second layer of solving is more of a financial plumbing question statement of, can you send a tokenized deposit? Do you need to convert it? Do you need to clear it? But there's many different models that are coming up for that. For example, maybe two banks have a strong relationship with each other, and so they can accept each other's deposits up to a certain limit. Or maybe there's a clearing facility in between them that effectively clears Bank A's tokenized deposit for Bank B, so that Bank B gets their own deposits or a stable coin, for example.
I see.
So yeah, so those are two parts of the equation. The first part is something that we're solving and have solved more or less with Providiums in our native atomic private interop.
I would say like these are probably like areas where you guys made a ton of progress, and definitely you guys like championing like ZK technology. I think it's like perfectly fit for like this type of like use cases, as well as like the sort of the efficiency of the blockchain for settlement, cross-chain transactions and so forth. Another component that although pops up is, I would say, control. So there could be definitely trade-offs between like public chain openness and sort of like private system control, I would say. So when you think about institutions, how should they frame that choice right now, in your opinion?
That is a good question. Because I think if you go to the different privacy solutions, right, where you have privacy solutions on one end where institutions don't really have any control. Then you have privacy solutions on the other end where institutions have complete control, and then you have this issue of having to trust operators as well.
Hmm.
What
It's a big.
we are solving for is a price solution where you don't need to trust the operators, but individual institutions still retain full control over their infrastructure and their network. And we find that the only really way to do that, and this is effectively a question of automating trust, right? Either you have zero trust in this, you have a system with effectively completely trustless, and there's no ability to implement controls, or you have a system that is fully trusted and you're able to implement full controls, but you are trusting a set of operators. We're essentially building a system where you, as an individual operator of your own Providium, you have complete control over who comes in, the types of transactions, what types of assets, who you can interact with. But at the end of the day, no one has to actually trust you because you are still, everyone can verify and enforce the rules based on cryptography and ZK proofs. So that is kind of our positioning on that view.
I
That
see.
you should be able to have control within your own four walls and your own assets, your own workflows, but all those controls should be verifiable and enforced cryptographically and privately as well. So this creates essentially a system where you are not necessarily trusting operators. You're trusting you're effectively putting trust in the protocol
I
that it
see.
is verifiable and it's enforceable.
I see. And this is like probably one of the qualities of blockchain technology and the stack that you guys have put together in solving like between like counterparties transacting economic value. I think it's like possibly one of the biggest achievements um, of the blockchain space, like sort of these type of solutions. And sounds like you guys are like positioned at the bleeding edge of that. Another definitely probably like another one of those benefits that the technology that blockchain technology is able to bring to banking institutions is probably had probably to do with settlement, right? And the sort of the convenience of like the efficiency there. What about what about that and like the programmability uh, of sort of like these tokenized deposits compared to like the legacy system?
Yeah, I think so compared to the legacy system, yes, it is a night and day shift, right? Because pretty much everything, almost everything starts to become programmable and enforceable through smart contracts and code rules. Now, that's not to say that you don't still have the various different, I would say, controls in place that might not necessarily be on-chain, but the programmability of a lot of these types of business logic, compliance rules, etc., definitely increases the speed of money and the speed of settlement quite a bit. The other thing too is not just settlement, but also, can you ensure something is atomically settled as well? What I mean by that is, let's say two parties are transacting with each other. I've got $100. You've got some sort of good, maybe it's some sort of security. How can we ensure that if I send the payment, I can guarantee that the goods are also sent to me, right? Rather, otherwise, right now in current systems and in a lot of blockchain systems as well, you've got this issue where maybe I send a payment, but then you decide not to send the goods, or I send a payment to you and you just never send me the goods. Sorry, same thing, I guess. Another problem that we're trying to solve on the settlement side is how do you make that atomic, where either the trade fully happens or it doesn't happen at all, and I get my money back.
Yeah,
So
that
that's
makes
another element, that's another layer of settlement types of niche problem statement that we're trying to solve for too.
totally, totally. And then I feel like this is going to become like super important as the customers of the banks will become like more accustomed with the sort of like whatever type of like digital system that is like improving UX on, every aspect of our life. And that I think it's a pretty easy bet to think that like that's coming for financial transactions as well. Um, but we talked about all of the sort of the positive aspects. So let's get into um, sort of the pain points. I want to ask you, um, where do you think the first serious implementation friction usually happens when institutions try to move from concept to live on chain money rails? Do you think it's governance, legal structuring, privacy design, like liquidity concentrations, integrations with the existing systems, or anything like that?
Yeah, I think all of those are definitely a factor. One interesting, I think, obviously, governance, legal, regulatory are definitely always going to be there. I think one thing that a lot of people don't necessarily consider as well is that, yes, just because a tokenized deposit or a stable coin can move 24/7, it doesn't necessarily mean that the underlying cash has actually moved as well, because you effectively have two settlement systems, right, in the banking with tokenized deposit or stable coins in the banking world. You have the actual on-chain system, and that can be fully 24/7. But at the end of the day, you still have the cash that needs to move from bank A to bank B. And that off-chain settlement system is still on, the old side. And this is probably going to be one of the biggest pain points that many are trying to solve right now. And you can see that with a lot of different central bank initiatives, because there's different layers of money and settlement, right? There's the stablecoin side, which is fully permissionless at the top. Then there's tokenized deposits below that. But then even then, further below that, a layer below is effectively the central bank money, banks being able to move money between each other. So you're like all three layers are kind of being solved. I think the stablecoin layer, where it's open permissionless money between wallets, has kind of been solved. The tokenized deposit one is starting to move along now as well. But then to really have tokenized deposits kind of represent full cash 24/7, central bank money also kind of needs to move on to on-chain rails too, because that would enable, effectively the cash side to move
That
24/7.
makes sense.
So I would say that is a very big hurdle. It's not necessarily something that comes up right away in terms of implementation, but it is something that is going to be neat. It's going to be a problem statement and needs to be solved in order for this to really reach like large global scale, fully move the entire system on chain. Other than that, I would say the first problems that generally do come up on the integration side is really just the off-chain systems. How do I reconcile with my core banking system? How do I ensure reserves are one-to-one and I've got the right controls in place? How do I connect it to my ERP systems like an SAP? How do I connect this to my treasury management systems? How do I connect it to case management systems as well? So
Of course.
yes, and because right now I would say a lot of the blockchains are isolated. They're not fully integrated into existing business processes, controls, finance, audit, etc. But that is also something that we've kind of solved with Providiums too. It comes with a lot of the core banking adapters.
Amazing. Yeah, definitely that makes sense. And I think about a lot of those challenges as sort of a natural occurrence of, system changing, and also like they're probably going to be an ongoing process. But luckily, I would say I would say right now there's probably way more than enough signaling and commitment from like the, I guess like the um, main institutions like and political figures, nation states around the world that I think are all pointing in the same direction, and it's very uh, I think it's very positive for like these kind of developments in the future. But we talked about a little bit about the sort of the difficulties. So maybe let's get on a more positive note. Let's get into like the use cases for tokenized deposits that can sort of enable like new utility for people. So, but or for like the very same institutions that we're talking about. So, what are some of these use cases that you can clearly see at the current stage?
Yeah, I think just having the ability to send money from one country to another or between banks just over the weekend is going to be huge. I don't think a lot of people realize most large companies or most even small businesses, etc., they have a pretty big issue of, okay, I need to be able to send this money at a certain period of time because the bank is still open. If you're a larger entity, you will have to effectively have a very large pile of cash just sitting there, effectively pre-funding between your different balance sheets and your bank accounts. That is a cost of capital, right? That is effectively your own money that is sitting there, not being used in any way, shape, or form, purely because of the inefficiency of how money moves today. So I think that is going to unlock a lot of capital for everyone from mom and pop businesses to larger enterprises, and that can be used in much more productive ways. Once we have tokenized deposits and stable coins fully integrated, and we're able to do 24/7 money movement even on weekends. So that's I think is absolutely massive on its own. It's going to have a huge effect on the global economy. Other ones that are very interesting is, you've seen with Hyperliquid, right? Trading oil and commodities and equities over the weekend. That is going to definitely pick up with the more regulated institutions as well. I think CME announced like this week, or one of the large institutions announced this week, that they're opening up 24/7 trading. You're going to see more and more of that. So that creates the additional utility or avenues for markets, right? Beyond just the 9 to 5 that they currently are.
Totally. No
Those
more
two, I think,
market.
yeah,
No more
those two.
market close.
Sorry?
You
Yeah,
know,
I cut you
no
off.
more market open, market close in the future. Just like continuous trading. That would be.
Yeah. I'm not sure how good that is for everyone that's constantly like checking their phone on the prices. Um, maybe it's good, maybe it's not bad. Maybe yeah. But when I look at things, I think those two are the ones that will have very clear immediate impact very soon.
Definitely, definitely. So, for the audience that is watching us right now, like, what would you say, like maybe in the next 12 months, um, that like sort of signals that they could monitor closely if they want to know whether institutions are truly moving from stable coin experimentation that went on just during the last years into many different like forms of like sandboxes into like real bank grade on-chain rails with tokenized deposits, for instance. What would you say?
Yeah, I think moving from proof of concepts to actual production systems, you'll probably start seeing more and more bank quarterly statements or quarterly earnings calls that talks about them. Definitely. That's something
Okay.
that we've necessarily seen, but you will see more and more discussions, not just by banks, but also by corporates talking about this. Because for them, it's a significant productivity, like capital usage and balance sheet optimization. So I think that is a very strong signal if you see CEOs talk about it on earnings or talk about it in general. Because most of the times, we see like the heads of digital assets of these companies or heads of innovation. But I think if more and more CEOs are talking about it, that is very much a clear signal that they're taking this very seriously and moving. That's from a more just, I think, communication point of view. The other one is just taking a look at the on-chain volume and the on-chain growth of stablecoins in general. We're already, I think, over 300 billion now. The volume of payments and the volume of stablecoin transfers is growing exponentially. So we can continue monitoring that and taking a look at that to see, is this how much more is this going to keep continuing going up? I think it's going to significantly. And exponential curves, are one of those things where it doesn't look like it's happening, but until it just happens and you don't even realize it.
Totally, totally. I can definitely see that um, being a big trend in the near future. So maybe final question in the interest of time, I guess. So how should banks decide whether they want to implement tokenized deposits um, or stable coins when building out their digital asset strategies then?
Well, the easiest answer is they can, reach out to me and we can chat about it. Um, but more seriously, I think they need to think through uh, very closely, like the underlying infrastructure that they're going to build on. They need to not just follow the momentum and the herd, but really think through what the architectural decisions that they're doing. Is it going to solve just one particular pain point, or is it something they can build on and it becomes almost like a platform play as well? Something that they can layer on additional utility and additional use cases on as they build this. And then also, what are really the trust assumptions on the infrastructure they're building? Is it do they have to trust different operators, or do they not have to trust anyone? And
Totally,
also,
totally.
how does it enable them to also be compliant
Of
as well?
course, of course, that's going to be um, one of their big um, preoccupations. But I would say that definitely, definitely, sort of like the architectural choices and like committing with the right partners is paramount. Um,
Yeah, I would say one more thing is interoperability. Interoperability, I don't think has been discussed enough in terms of the architectural choices, the risk profiles, and the trust assumptions on that as well. As more and more institutions come on chain, interoperability starts to become a much, much bigger question of how to solve.
I see. I see. Yeah, totally. That's um, that's going to be I guess like nobody will make the same decision, right? So we will have to have these rails to be able to like transact with like different forms of like tokenized deposits or stable coins. So I guess that's gonna be super important for institutions as it is for any other blockchain user. Um, okay, so I think we have just 1 minute left. So maybe something that we didn't cover, some like specific, some more thoughts that you wanted to share with the audience about what ZKsync is doing for stable coins. for tokenized deposits and banking institutions?
Yeah, I think the space is just getting started. Obviously, it's very much heating up. There's a lot of interest in privacy solutions, interoperability solutions, specifically for regulated institutions. And you'll see a lot more of us, a lot more about us with Providiums and the network that's getting built out for regulated institutions, fully private, native interoperability, no trust in the operators, all cryptographically verified. And so I think this is going to be a very interesting time, very interesting year. There's going to be a lot of movement and exciting things that are going to happen.
Yeah, I can't wait to see this future that you guys are helping to shape right here. It's going to be exciting. So I think we are short on time. So yeah, maybe time for some greetings, and it's been a pleasure chatting with you, sir, and looking forward to the fruits of this work, and seeing the on-chain growth trend continuing. Um, so yeah,
Oh, pleasure to be here. Thank you for having me.
awesome.